Hello guys, welcome back. So DoorDash is a company that I'm pretty sure you know about, and if you have been living in the US or you are living in the US currently, I'm pretty sure you have used at least once. I have myself, and it's very convenient. Now I have opened up the stock news module in which we can examine news about DoorDash, what's going on with the company. And the first thing that you spot here is that the food delivery is now a $150 billion business, which I actually thought it would be even more than this. But uncertainty and lack of profit continue to loom. And that's very interesting and important. And this is what we want to examine next. What's going on with DoorDash and whether they are profitable or not, and whether they are actually paving towards profitability or not. So, as you'll see here, the stock has been having a 1 year high of $257 down to $72, along with the crashing stock market pretty much. Another stock that has crashed tremendously, and you would expect that from a company that is not making money, of course. And I have talked about it many times in the past. It always pays to buy companies that make tons of profit, tons of free cash flow, because even in the case of a slump, of a massive downturn in the economy, as it's currently happening, it looks like you have this margin of safety in which you have bought a company that is doing well and it's making money, and so you, for the most part, have nothing to fear really. But if you are owning a company that is not making money, then things are tough. And we're going to examine DoorDash and see whether that's the case with them. Now, if we take a look at the max chart, you will see that its IPO days were much better, but now it's being in a pretty much strong downturn, a downtrend also that's keeps going on for a while now. Now, the P ratio of the company is negative because the company is not making money. Of course, a P ratio becomes negative when the earnings are negative, because the price can never be negative, of course. And so you will see that it's been pretty much negative all the time, and the price to free cash flow ratio is positive but very high. Now, insane dilution here going on for the company, issuing more and more shares back in the first few years, I guess, of its IPO days, when the stock price was higher. They tried to take advantage of that, and this is why they kept issuing shares, massively diluting investors. Horrible thing to see if you bought earlier. So yeah, that's not looking great at all, for sure. Now, yeah, the free cash flow to total liabilities is fair. Looks like the company may not have too many total liabilities. We will examine that in a little bit of a detail. Great revenue growth here, but negative net income, and negative net income growth as well. So it seems like we're going down from what we used to be. And this is a big problem with non-profitable companies. Like, picture yourself looking at this company in 2008 and they were losing $200 million, and you'd be like, okay, maybe I can actually invest something expecting that the company will be positive in the next 2 or 3 years. Yet 4 years later, the company is actually losing more money than what they were losing back in 2018. And so this is why it's very dangerous to invest in non-profitable companies, even if they are very well known ones, as DoorDash is. The 5 year free cash flow growth has been increasing. We will examine why that's the case. Still marginally positive. And 5 year total equity growth also increasing. They have sold a lot of stock though, remember that. And the margins are negative here, of course, and returns are also negative. So it's not painting, the whole analytics here are not painting a great story for the company here. Now, I want to take a look at the income statement. Let's see what's going on. Of course, we're expecting revenue that keeps increasing, so the revenue has been pretty much great for the company. But if we take a look at the net income, you will see that this has been going down, and this is a terrible thing to see. You really don't want to see that. You hate to see that, especially throughout the many years. And if we take a look at the total equity of the company, you will see that it keeps increasing. But the reason for this one is the additional paid-in capital. Look at the 6 billion, for instance. The company is actually issuing massive amounts of share, and this is how they're funding their assets here. For the most part, this is how they are making their total equity. Now, if we take a look at the cash flow statement, Notice that we're beginning with a negative net income, and so we are ending with positive cash provided by operating activities. And you may be asking how that's the case, and this is the case because of stock-based compensation, depreciation, amortization, some change in working capital here. But for the most part, the values that tend to remain the same are going to be, or similar, the stock-based compensation, the depreciation, amortization, which are non-cash expenses, and this is why they are added back to the cash flow statement as cash from operating activities. They are extracted from the net income because they are an expense, but they are not a cash expense, so they are added back here. And this is why you are looking at negative net income and positive net cash provided by operating activities. Now, investing activities cash flow is negative here, and means that the company is investing more money in the last year than before as well. Now, you have to notice and you have to always remember that companies tend to like to show operating cash flow that is positive and try to draw attention to that. But this is why it's important to realize that this comes from negative profit. And this is why our stock evaluation tool takes that into account as well, not just the free cash flow. We're examining all sorts of profitability metrics from the company to make sure that our free cash flow comes from profitability and not from an adjustment of stock-based compensation and depreciation and amortization, which is more and more the thing these days. Cash from financing activities is also negative here because the company is paying back some debt. Good thing to see as well. And a little bit of cash that the company has here as a cash position. And the free cash flow, as I mentioned earlier, is positive because of what we showed earlier, stock-based compensation, depreciation, amortization. And yet, the previous years, it was negative or close to that. A little bit of positivity here, about 100 million, but still close to zero. So, okay, the stock evaluation tool is what is going to tell us what an interesting price to pay for DoorDash could be. Now, revenue growth could continue to be great for DoorDash, and I'm willing to give it a go here, give it maybe 20, 22, and 24. Actually, saying to myself that, okay, I accept that the company will be accelerating in terms of revenue growth. But if we take a look at the net income margins here, these are all in the negative. Now, it is getting a little bit better, which is, of course, great. But if we are an unprofitable company, we cannot go to very, very high profitability very, very soon for the most part. It's unlikely. And so I have to go low here. I may go something like 1, 3, and 5, aiming for some marginal profitability to begin with for this company, and then we'll see how it can treat us in the next few years. But right now, this is a leap of faith because the company is not profitable yet. And now when that happens, the free cash flow margins that we are potentially looking to get here, you can see these values here. These are not going to be very reliable to use because, again, we are having a negative net income, negative free cash flow. This cannot really tell us anything about the free cash flow generation of the company because it is not based off of profitability, as I mentioned earlier. Now, when we get to profitability, we typically want to make something like, let's just say 70, 80, and 90% of our net income back as free cash flow. And this is what our free cash flow margin that I'm going to be using here is. Now, of course, even if this looks high to you, it won't affect our model too much because of suppressed net income margins, which are to be expected. And so even if this is even higher than this value, it won't affect the whole model too much unless these values become way, way higher here, which would make a lot of sense because profitability has to play a big role in how free cash flow gets generated. And annual return of 13% is what I like to use pretty much with all my stocks, all my projections, and I hit calculate. And then as you'll see here, we are looking at much lower values than what we currently have for our current stock price. Again, the current stock price is almost treating the company as it's making billions, not as if it's a company that's not even making profit yet. And so people have been relentlessly buying this stock, pretty much taking it extremely high in terms of its stock price. And this is why it fell a lot. But even after falling that much, you see where it is right now compared to its financials. And even when I'm willing to go positive in terms of net income, still our high estimates are way off from the current price. This is why I feel DoorDash right now is definitely not a buy. A very, very overpriced company that I wouldn't even think about adding to my portfolio right now. and I hope this video can actually tell you why and can give you an idea of why this whole evaluation really needs to happen before taking a position at this kind of company, or these kinds of companies that are, there are so many around these days in the stock market, companies that are very hyped up and are not making money. You have to be super careful about those. Thanks for watching the video. I hope you enjoyed. Please remember to leave a like and subscribe, and in the meantime you can also watch this video that I made earlier. It's about Shopify, which is also crashing, as you would kind of expect eventually. And again, thank you for watching. I'll see you in the next one. Bye bye.